Let's unpack the market action. We've got Dean Orrico, President and CEO of Middlefield Capital, joining me on the desk today for the next half hour. And Dean, it's a great day to have you because there's a lot of macro and there's a lot of micro that we can talk about. And I joked earlier this morning that, you know, if Higher for Longer was a hit song, right now it's sort of plunging in the charts because we've got this new tune that, all right, maybe the work is done because of the sell-off we've seen in the bond market. How do you think about what looks to be a universal Fed pivot?
Well, I think you can still safely say higher for longer, so I'd like a royalty on that for sure, because, you know, the reality is, although it looks like, you know, the 10-year in the U.S. has kind of peaked at 4.8 or so, made its way back down since the war, which began on Saturday, I think you're still going to see rates higher than what we saw, you know, pre-2022. And I think that's likely because inflation is going to be stubbornly higher than what we saw pre-2022. So I think we need to prepare ourselves for a world where money isn't free anymore. You just can't throw a dart at a dartboard and say, you know, this stock's going to do well. I think you need to be more selective in this market. And this is certainly a more challenging market than we saw, you know, for that 10-year period from 2010 to 2020.
But is this better if you're a money manager? Because now you can say, listen, you don't just buy an ETF that goes up, stock selection matters.
I think that's the main point, Amber. I think you're now looking to allocate capital to active managers. Not all active managers are going to do well. And I think if you've purposely looked at portfolios where you're focused on companies generating real cash flow, lower levels of leverage, and are prepared to pay that cash flow out to investors, i.e. growing dividend stocks, I think that's going to be a good place to be for the foreseeable future.
And yet, you know, yield has not yielded anything so far this year. Now, part of it is because of the rate story, but do you expect that to turn? I mean, if you've got a high dividend yield, if you were a dividend payer, you did not outperform this year.
Absolutely. It's been a challenging environment. So when people ask me, you know, who's your biggest competition? I'm not going to highlight another money manager. My biggest competition is GICs these days, and, you know, government debt, if you will. And that's not going to last forever. Although rates will remain higher, I think you're going to start seeing them edge down, you know, fast forward 6 or 9 months. And what happens is it pivots pretty quickly, Amber. So I think as a result of that, you need to start looking beyond just holding a GIC and say, okay, where can I actually get growing dividends at discounted valuations? And I think there's a lot of good examples in this market.
Okay, so the banks are a prime example of that, but they are facing a lot of headwinds, weak sort of capital markets. So you're seeing signs that's coming back to life. And, you know, people can still put their money in a 5% bond, so waning deposits, and concerns about credit quality. That's a lot of assaults for these Canadian banks. Is valuation enough to bring you in? Not
yet. I think there's good reason, based on some of the points you mentioned, to be a little bit more cautious. At the end of the day, we know the Canadian banks in particular are very well capitalized. Yes, they're going to have some headwinds as a result of mortgages coming due late next year into 2025, especially if rates are much higher than they were, you know, when people bought those homes in 20 or 2021. So I think you need to be concerned. The other thing is the banks, generally speaking, really brought on a lot of new employees, and you've already seen some of the independents, non-banks, already start reduce that employee headcount. You could start seeing that in the banks as well.
We've seen in some instances, RBC, for example.
You got it.
Yeah.
So now that they're going into reporting season, fast forward the next 4 to 6 weeks, I think you're going to start seeing them make some announcements to reduce that headcount and restore that operating leverage, operating earnings number that they historically benefited from, you know, pre-COVID.
You made me think that, you know, we keep waiting for this recession to show up tomorrow and taking comfort that the skies are going to clear in 24 and 25. But isn't that when the big problems will start to emerge, particularly in the housing market? Because all these people that held on through extending their amortization, they're going to run out of that room, you know, 25 and onward.
The offset to that, which I think will temper this economic slowdown, I think the economy is slowing. Do I think you're going to a hard landing? No. And I think one of the reasons is that, you know, the consumer continues to be in good shape, not necessarily because, you know, they've got a lot of savings. As you say, those savings have burned off in the last, 4 to 6 months. I think what's also happening is that you've got an employment market that continues to be very strong. So you're effectively at full employment in the U.S., full employment in Canada, and even if you start to see, say, the banks in Canada start to reduce their headcount, these are generally white-collar jobs that have pretty good severances. And, you know, on the blue-collar end of the economy, you know, those jobs of, you know, in the trades, that's where we've got a real shortage. We don't expect any real reduction in employment in that part of the market. So white-collar jobs reducing, I think that's going to be tempered by, you know, pretty good severance packages, which allows us to kind of skate through this, you know, better than what we've seen in previous recessions.
Because I know you're a dividend guy and a balance sheet guy, I wonder where energy is on your radar today relative to where it was, you know, a couple of years ago. I imagine this was not a sector you looked at.
Yeah.
Now, what is it?
Yeah, you're absolutely right. We effectively went through a depression in the energy market from, say, 2015 to 2020. Recall in the early days of the pandemic, we even had negative oil prices. And we're at a world today where it is starkly different. And I think things really changed on Feb 24th last year when Russia went into Ukraine. And I think people have woken up to the fact that, yes, we're going through an energy transition, but this is not going to play out over months. It's going to play out over decades. And you need fossil fuels, and Canada has an abundance of fossil fuels. And as a result of what happened in Israel on the weekend, I think it's also causing people to say, well, you know, these fossil fuels, you know, maybe in reduced supply if in any way Iran's involved in this and production out of Iran starts to slow. I think all these things are conspiring to say fossil fuels is important, just like we saw this morning with Exxon and Pioneer.
So how do you play that? And are you concerned about M&A back in the market because you prefer to see that come through in dividends and buybacks? You don't want them going back to that old playbook.
It's a great point because we own a lot of these high dividend paying energy producers, and while we love seeing them getting taken over at a massive premium, by the same token, it's a real problem when they're pulled out of your portfolio. Having said all that, we think there's still plenty of good companies to choose from.
Like what?
And you know, in the Canadian market, you know, we continue to love like a Canadian Natural Resources. When you think about the production growth in that business, and it's got an annual growth rate in its dividend of over 20% over the last 20 years, you're hard-pressed to find that anywhere, Amber. So it's such a great business. You've got names like Tourmaline, which we also own across our portfolios. And then I'd even say in the pipeline businesses.
I was just going to ask about that because those are struggling for a floor.
They are, and I think it makes them especially attractive in this kind of market. So if you share our view that, you know, the long end of the curve is now kind of peaking and could plateau here for some time, I think that gives investors comfort with the short end of the curve effectively, you know, peaking now as well because we think central bankers are largely done. I think that gives investors more confidence in going into some of these highly stable, high dividend paying pipelines like an Enbridge.
Well, is there anything Ozempic can't do? There's a new study of the weight loss drug that shows it can now be used to treat patients with chronic kidney disease. This is sending shares of Novo Nordisk and Eli Lilly trading up. It's creating some disruption in the likes of Baxter and DaVita, which are exposed to kidney care. Let's bring back Dean Orrico, President and CEO of Middlefield Capital. Okay, Mr. Balance Sheet, Mr. Valuation, do you own these companies that are making, you know, blockbuster disruptive drugs?
We do, and while they've got great balance sheets, they are expensive. But Amber, in fairness, you're getting growth like we haven't seen in single drugs, and certainly in my lifetime. Like, these are major blockbuster drugs. And, you know, Novo just released a study last week that basically showing that, you know, this is doing wonders for people who are actually historically would have suffered from cardiac issues. So that weight loss is having all of these knock-on effects. And then there's the spillover impact on, you saw Walmart announce last week that, you know, they're seeing less consumption or buying of snacks and all that kind of thing. So I think it's going to have a ripple effect right throughout the market.
Is this like, is it here now, or is it like generative AI where we're like, this is going to be huge, just watch for it? Because I'm looking at the forecast for Novo Nordisk, 25% growth, which is not bad, but they've been doing that. 20% growth in 2024? Like, is that not priced in, or is that the growth?
I think that's the growth, and I think the market's reflecting that. And I think it's fair to say, based on everything we're seeing and some of the studies that have been released, that this is, you know, the real deal. I think these products are going to continue to do very well. There's going to be debate around, you know, are insurers in the U.S. going to be covering these for weight loss as opposed to diabetes? And I think that's going to take some time, and that might become, you know, a bit of a headwind to growth going forward. I think in the fullness of time, assuming these ancillary benefits play out the way these initial studies show they will, then I think everybody's going to get on side.
Okay, but do you look at the reports that come out about the negative side effects, and how do you figure out, okay, every drug has some negative side effects. Is this just that, or is this the makings of a much larger problem?
Yeah, so what we've seen so far is that the potential side effects have been relatively limited. And put differently, the benefits are far outweighing the side effects. Now, yes, these drugs are in a higher dosage, and I think more studies and time needs to confirm that they continue to be safe. But assuming that works out, then I think you're going to see a net benefit, not only to these patients, but to the whole healthcare system generally.
So then you must have to alter your thinking on how you're going to approach your healthcare investing if you think it's going to be so game-changing. So like the DaVitas, the Baxters, are you thinking about all those others that are going to suffer?
So you're absolutely right. I think it has a knock-on effect throughout other segments of the healthcare system. So for example, some of the med tech names that make knee replacements or transaortic valve replacements have been hit because the thinking is that you're going to have
like
less demand for those, like a Stryker. But I think what Stryker's recently announced is that, in fact, they're seeing continued demand for their products because individuals with a high BMI weren't actually eligible for certain types of procedures in the past. So now that they're actually don't weigh as much, they're actually can have that procedure. So we really don't fully understand yet, you know, what the knock-on effects are going to be. But based on the work that we've done, we think some of these med tech companies will continue to do very well.
And is there something that you're doing to offset this? You got a nice boring name that's just stable, like just in case, you know, they could miss by a penny or two. It could come in a light, and, you know, there's so much air in these stocks.
Yeah, there's air in, say, the Novos or the Lillys, because they are the two big players in this space. But, you know, you've still got the Mercks of the world and the AstraZenecas of the world that continue to kind of be in the other areas of the healthcare sector that do well. And they're all trading outside of Lilly and Novo at pretty discounted valuations, discounted to the broader market. So we're seeing good value, good margin of safety in those names.
And because you look at dividend yielders, are you now getting excited about the relief you're getting from the bond market and stepping into utilities, real estate?
Yeah, so if you think that we're kind of at or near the peak on yields, both short-term and long-term, as we discussed a few minutes ago, then I think you can start getting excited about some of these more interest-sensitive names, many of whom are trading at, you know, really cheap valuations, and as we were discussing earlier, are not only dividend payers, but they're maybe more importantly dividend growers. And I think when you look historically, Amber, at stocks that have a track record of raising dividends over time, they outperform over the long term. And that's really where we're focused at Middlefield. Okay,
so let's talk about that. Real estate is a real PowerPoint on the S&P today. You know, names like Boston Property, Simon Property, Kimco. So those are a little bit more consumer focused. Here in Canada, you've got residential exposure, industrial, commercial, office.
Yeah.
Where are you in that spectrum?
So I think it's still too early to jump into the office sector.
Okay.
You know, you've got, say, Canada, 17, 18% vacancy. There's still lots of debate about work from home. And you've got a number of older buildings that may, in fact, never be occupied again from an office perspective. So we're going to have to figure out what to do with those. So I think that sentiment on office is still, you know, quite negative, and I think you need to basically stay out of that market. And I think that's in stark contrast to what you're seeing in industrial. You know, it's cheap. Rent growth is still growing. You've still got less than 2% vacancy across Canada, less than that in the GTA. Multifamily. I think the multifamily sector has hit a pivot point in the last 3 weeks because there's been this overhang about the federal government going after the residential REITs and, maybe trying to control their rents. I think, Amber, that changed in the last 2 to 3 weeks because they now, I think, fully understand that this is a supply issue, not a rent control issue.
But is that also going to be a problem down the road? More supply means less rent power?
If I had to snap my finger and say, fine, but it just doesn't happen that way. So I think the fact that they're going to waive GST in the provinces on the provincial portion, I think that's very constructive, but it's not going to drive supply up anytime soon.
So top idea is industrial REIT and a multifamily?
Multifamily, and I can't ignore the grocery-anchored REITs in Canada.
Remind me
So you're talking RioCan. You're talking Smart Centers, First Capital. If you talk to these CEOs, they'll tell you that the fundamentals in their business in grocery-anchored retail have never been better. So best example of that, early this year, Bed Bath & Beyond went bankrupt, as we know, 65 locations in Canada. All of those locations was released, on average at a higher level within, 8 weeks.
Oh, wow. Okay, so that's kind of the reality of what we're seeing. You're getting a relief in the bond market. Utilities, boring sector. But, I mean, the underperformance, especially in the U.S. relative to the S&P 500, is historically significant. And here, the TSX utility sector bouncing off the lowest level since 2020. Where are you buying?
So that's been a true rate trade.
Yeah.
And again, with rates now kind of peaking and coming down over the past 4 or 5 days, you're seeing this bounce back, as you say, in the utility sector. So, we like the AltaGases, we like the Capital Powers, even Brookfield we think is well positioned, really cheap. Brookfield Renewables doing very well. Brookfield Renewables. Brookfield Infrastructure Partners, not really utility, but high dividend payer. So we think those are well positioned too. And I wouldn't
What if you're wrong about rates? What if it goes back to 5%?
Well, you've got a low valuation. And I think that's always a cushion for you. And will these stocks rebound? Probably not. But I think you've got a low valuation and a high yield, and that yield's not going anywhere. So I still think it's probably going to be a good place to park your capital. Now, if rates go to 6 or 7%, then I think it's, different game plan. And that applies to the whole market, not just the utilities.
What are you going to do if rates go to 6%?
If rates go to 6 or 7%, I think you've got to seriously consider having an increase in your cash portion of your portfolio.
All right, that's definitive. Before I let you go, when you look at your allocation across North America, Canada versus U.S.?
So in our more diversified funds, we'd probably be closer to about 50-50. In our real estate-focused funds, we'd be much more skewed to Canada because we're seeing better supply-demand dynamics, and we've got lower rates up here. And then in our healthcare strategies, definitely more skewed to the U.S. because we really don't have a public healthcare market in Canada.
No, we don't. All right, thank you very much. That's Orrico joining us from Middlefield Capital on the desk for the past half hour.